Hello everyone and welcome back to another video. My name's Sam and today we'll explore the age-old debate in trading, fundamental versus technical analysis. These methodologies serve as the foundation upon which traders base their decisions, yet they differ in their approaches and philosophies. In this video, we'll be breaking down their key differences whilst also examining how they can be combined for a better trading experience. But before we begin, if you have any questions or suggestions for a video topic, feel free to comment down below. And of course, stick around to the end of this video so you don't miss out on anything important. Let's begin. Fundamental analysis aims to figure out how much an asset is really worth. It considers both rational and irrational factors, like a company's earnings and profit margins, and less logical stuff like how people feel about the market and what the media says. By focusing on the rational parts, fundamental traders try to see the true value of an asset. This helps them decide if an asset is worth more or less than its current market price, so that they can make money by buying undervalued assets or selling overvalued ones. If they think an asset is undervalued, they'll buy it. If it's overvalued, they might sell it or wait for a better time to buy when its real value drops. This type of analysis can take two main approaches, top-down or bottom-up. In the top-down approach, a trader begins by evaluating the overall health of the economy. They look at various macroeconomic factors such as interest rates, inflation, and GDP levels to understand where the economy is headed. A trader who follows the top-down approach starts the analysis with the consideration of the health of the overall economy. From here, they spot the industries and sectors with the most promising investment prospects. Once they've identified these areas, the trader digs deeper to assess specific opportunities within them. Finally, they select individual stocks within the most promising industries to build their investment portfolio. Alternatively, we have the bottom-up approach. Instead of starting the analysis from the larger scale, the bottom-up approach immediately dives into the analysis of individual stocks. Those who prefer the bottom-up approach believe that specific stocks have the potential to outperform the broader industry. This approach is primarily focused on various microeconomic factors, such as a company's earnings and financial metrics. Traders who use such an approach can develop a thorough assessment of each company to gain a better understanding of its operation. On the other hand, we have technical analysis. It revolves around studying historical movements of an asset to determine an expected future price. Traders who use this method essentially believe an asset's chart tells a story. Unlike fundamental analysis, which often looks at long-term gains, technical analysis is all about fine-tuning short-term trades. Short-term traders turn to technical analysis when they want to optimize the returns on a trade. By anticipating price movements based on historical trends, traders can find the best entry and exit points for their trades. Technical analysis employs various strategies, including moving averages, Fibonacci retracements, and Bollinger Bands to determine value. A common technique in technical analysis is the use of candlestick charts. These charts show bullish movements in green and bearish movements in red. The size of each candlestick indicates the difference between a market's open and close prices, while the protruding line, or wicks, show the highest and lowest prices during the trading session. There are multiple approaches to analyzing candlestick patterns over a specific time frame, each focusing on identifying recurring patterns. Additionally, traders utilize moving averages for longer-term analysis, which helps smooth out price volatility and determines the overall trend direction of an asset's price movement. For example, a commodities trader might track the 21-day moving average of oil prices and compare it to the current price. If the current price surpasses this average, it suggests a potential bullish trend, indicating a possible further increase in price. Moving on, let's look at the key differences between fundamental and technical analysis. These will help you understand which approach fits your trading journey. 1. Fundamental analysis is used for long-term investing, whilst technical analysis is employed for short-term investing. 2. Fundamental analysis can be used for both trading and investing. Conversely, technical analysis can only be used for trading. 3. The aim of the fundamental analysis is to determine the fair value of an asset. On the other hand, technical analysis involves finding price trends and identifying optimal entry and exit points for a trade. 4. Traders using fundamental analysis look out for past and present data, including macroeconomic indicators and company earnings, whilst those who use the technical approach care about historical data related to an asset's price. Now that you know some of the key differences, let's take a closer look at what happens if you combine those two analyses together. Imagine you're considering trading stocks of Apple. Analyzing the trading volume, you notice a significant rise over the past week, suggesting increased interest and positive sentiment among traders, potentially signaling a price rise ahead. But just looking at volume isn't enough, so you also check Apple's basics, like its financial reports, industry trends, and recent news, to see if it's a good long-term investment. Even though you think Apple could do well in the long run, you also monitor short-term price changes, identifying key support levels through technical analysis. Using a simple way of analyzing, you spot certain price levels where the stock has bounced back before. If the stock hits one of these levels again, you might see it as a chance to buy. You also study past reactions to events like earning reports, anticipating responses to future announcements such as interest rate changes. By combining fundamental and technical analysis, you make informed decisions, using volume to gauge sentiment, fundamental for long-term assessment, and technical indicators for short-term insights. This comprehensive approach empowers you to deal with the ups and downs of the market, potentially making your trading more successful. Alright, let's summarize what we've learned today. Fundamental versus technical analysis. Fundamental analysis has a long-term focus, considers company earnings and industry trends, whilst technical analysis has a short-term focus, looks at price movements for trade, entry, and exit. Key differences: fundamental approach determines assets' fair value. However, technical analysis identifies price trends. Combining methods, you can use both fundamental and technical at the same time for smarter trading decisions. And that's it, folks. Let us know if you have any questions on the topic. And since you're still here, we'd like to know which type of analysis you prefer the most and why. Simply scroll down and leave a comment. Don't forget to like the video and subscribe to our channel, and since you've made it this far, here are 2 more videos you might like. See you next time, folks.